Hey, I'm Zanzi and everyone connecting from elsewhere in the world. My name is Dawn Numdu, editor at Food Form Zanzi, and I'm really happy to be back with you on this platform. As you know, this is a segment that we're doing with Standard Bank, and I am joined by Bertie Hamman, Senior Manager for Agribusiness at Standard Bank. And we've been going through different aspects of finances, how to run your business, and how to make sure that you're on par with everything that you need to do. Now, in today's topic, hello, Bertie. Before I get started, I
Hello,
want to
Dawn.
get the ball rolling without you.
Hello, Dawn, and hello to all the viewers out there. It's a pleasure to be here.
I'm happy to have you again. Now, in this week's topic, we will discuss the benefits and disadvantages of having debt, and possible indicators of the pivoting point, the point where the disadvantages start to overshadow the benefits. We listen to economists and they warn about the risk of being indebted. What are the reasons for farmers incurring debt, and is it even possible for a farm to be debt free?
I think that's a good question. And maybe, if I can sort of fall back on the old saying, too much of anything is actually bad for you. And that's very true for debt as well. So if we can maybe recap, initially we spoke about budgets. Then last time we spoke about profits and cash flow. Today we will be focusing on another big letter of the alphabet, which is D, standing for debt. I think, coming back to your question, there's maybe two reasons why farmers will be incurring debt. Initially, when we spoke about the budgets, we said, one of the benefits of the budgets is that if you budget properly, you will see when you're going to be requiring a bridging loan. Now, that is one of the reasons why you will be taking out debt. We said that, there will be a period in the year when you will be incurring a whole lot of expenses. Then a while later, you will be hopefully receiving an income. A bridging loan then bridges the period between having all these expenses and when you will be receiving your income. So that's the one type of loan which farmers will be incurring, which is then a bridging loan or a short-term loan. And when you receive your money from your crop or selling your cattle, the important aspect here is you will be repaying your bridging loan in full. In other words, there will be no money outstanding. The second reason for incurring is to buy longer term assets. Now, that is, for example, when you incur debt to buy a farm or you buy a tractor or you buy a bakkie. Now, the difference here is in a long-term debt, you will have to receive income or profits over the next number of years to actually repay the loan. So it's not you receive money in the 1 year and then it gets repaid in full. It's a repetitive process over the next number of years. And I think those are maybe the two important reasons why you incur debt. Short-term for bridging finance and longer-term to buy more longer-term assets. So if we can see these two reasons why you will incurring debt, short-term and longer-term, I think your next part of the question was, is it possible to be debt-free? Now, I must say, in my experience, in 25 years in the bank, I've maybe seen a handful of farmers who have very little debt. But for the rest of them, the rest of us, debt is part and parcel of how we run our farming practices. So I think in practice, debt will be part of the requirements. And I think in farming, there's a couple of reasons for this. Number one, I think the capital requirements is of such a nature that you need funding. I think the next one is there's a lot of seasonality. And then also the third reason is a lot of volatility in farming. And all of this make, agriculture quite capital intensive, which require debt funding. And I think more so in agriculture than in many other sectors. As a matter of fact, when we as bankers, look at the portfolios which you are responsible for, we typically find that you get deposits or investments and then loans on the other side, right? And typically, between the portfolio that is made up of thousands of customers, there are more investments than there are loans. But agriculture is just the other way around. We see that actually the loans far exceed the investments. So agriculture is very capital intensive, and debt plays a very big part in the running of a farm.
And what happens? What are the main benefits and main advantages of debt, Bertie?
Well, let's try and answer that by referring to the longer term debt, which we just now discussed, and the shorter term debt. And if we start with the longer term debt, and without going into too much academic theory, let's keep it practical. I think for all of us, if we first had to save the money to buy a house or a car and buy that cash, very few of us will actually own any houses or any cars. And the same is true for agriculture. I think the primary benefit then of incurring debt is it gives you access to then go and buy an asset, which you can use to generate money or income in the future, and that money can help to pay off the loan. So that's the primary benefit of having debt. It gives you access to assets. I think the major disadvantage of this long-term debt is because it must be repaid over the next number of years, which means that you will have to receive an income and surplus cash flows for many years to actually repay it. And that is then the danger. If you are, for whatever reason, not able to generate that income, profits, cash flows to repay the debt, then it means you're actually putting your entire estate at risk, because your asset is going to be repossessed. So that is the main disadvantage of long-term debt, the fact that you have to generate revenue over a long period of time to go and repay it. When you look at short-term debt, the major advantage there is the liquidity it provides. Let's say, for example, you used all your cash to go and plant your crop, buy your cattle, but now you have to grow your crop or your cattle. The short-term debt is used to pay all your expenses in the interim until you actually then get the proceeds of selling your crop or selling your cattle. So the liquidity is the main advantage of that. I think the main disadvantage associated with short-term debt is unfortunately associated with ill financial discipline. Remember, in the budget we said you budget to create financial discipline. So what I mean here, maybe you've got an overdraft, and you think you're going to be making lots of money when you sell your crop or your cattle, and you, so to speak, counting your chickens before they roost, before they hatch. And what now happens if you don't make all the money from selling your crop as you expected? And that's the main disadvantage of short-term liquidity, is it gets used for the wrong purposes.
Yeah. And when will I know that I have too much debt? Sometimes farmers get themselves into tricky situations. They anticipate certain things will happen and it just doesn't come through. When will I know that I have too much debt?
Yeah, Dawn, I think ironically, farmers and all of us with too much debt kind of know that without anyone having to tell you. So why do you end up in this position in the first place? I think, those are maybe the important things then to consider. And I think the first reason why you end up in a position where you have got too much debt is probably because you didn't prudently budget. If you did a prudent budget, as we discussed in previous episodes, you are less likely to end up in a position where you've got too much debt. Now, I think the important thing here to remember is that very prudent budget process of yours must start when you are still a young farmer, because it's the right and wrong financial decisions you make at an early stage that will actually impact and influence your longer term financial position. So that's the first thing to bear in mind there. I think the second one is ill financial discipline that end up in you buying bargains, which in the long run turn out to be anything but a bargain. So that's it, smart financial decisions one must make. And then I think, thirdly, and I must stress, this is more the exception than the norm, is maybe the dice just fell for you repeatedly on very low scores. So you maybe had very bad luck for a long period of time. But like I say, this third one is more an exception than the norm. So those are the reasons why you end up in a position where you have too much debt. So perhaps you want to plan for the future and you ask, well, are there any important financial numbers I need to consider? Now, I think in that regard, there's not maybe one specific number that stand out as the golden rule, but there's maybe a couple of things for us to consider. The first one is prepare a very prudent budget, and you must prepare your prudent budget yourself. Yes, you are most welcome to get help from other people who's maybe experts to compile the budget, but at the end of the day, you must prepare the budget, and you must know the assumptions around your budget inside out, and you must be happy that it's realistic and it can be achieved. And then follow your budget diligently, as good as you can. That's the first thing to remember, and that will hopefully avoid you ending up in too much debt. Maybe one or two numbers to consider. An important number can be, for example, if you compare all your current assets with all your current liabilities, and your current assets should really exceed your current liabilities by 1.4 times. We refer to that as your current ratio, and I'll suggest to ask your accountant for a bit of guidance to calculate this ratio if you aren't sure. And the next one, which can also be a kind of important indicator, is where you compare all your free cash flow. Now, your free cash flow is the money you have left all after you paid all your expenses. And this free cash flow must cover all your debt obligations. That's the capital and interest you must pay also by 1.4 times. We typically refer to this as a debt service cover ratio. And again, I'll suggest, to speak to your accountant, maybe help you calculate this ratio. And I think if you can achieve a current ratio of 1.4 and a debt service cover ratio of 1.4, and you budget prudently, you are less likely to end up with too much debt.
Bertie, by the sounds of it, everything leads back to the budget, and that was our first discussion here on Food from Mzansi TV. I just want to ask one question, and everything that we've discussed today, it doesn't matter whether you are at what scale you're operating. It really applies to across the board, right?
Don, you are absolutely true. If you are a small or emerging farmer or you're a big commercial farmer, it all starts with the budget. It all starts with, budgeting prudently and very, very good financial discipline. That will eventually, I think, be the considerations that take you forward and allow you to achieve your ambitions as a farmer.
Yeah, thank you so much for this fruitful discussion again, Bertie. He is the Senior Manager for Agribusiness at Standard Bank. I really appreciate your time, Bertie, and thank you so much again for joining us here on Food from Mzansi TV. We are looking forward to our next discussion, and you can, of course, also catch him on our weekly podcast called Farmers Inside Track. Really enjoying his inputs on that same platform as well, also talking about the similar topics and covering all the points that we've covered here on Food from Mzansi TV. You can also go to www.foodformzansi.co.za if you missed any of our episodes. We are uploading these weekly TV sessions and the podcast on that platform. Thank you so much, Bertie. Really appreciate it once again, and a lovely day to you further.
Thank you very much, Tony. Goodbye to all you and the listeners.